The exam costs $1,400 in fees alone. You've taken it 4 times across 18 months, studying in a studio apartment where the radiator sounds like someone slowly dying in the walls. You pass on the 4th attempt. CPA. 4 letters that cost you 3 years, $67,000 in student loans, and something harder to name. The version of yourself that still believed credentials were the same thing as a rival. Your first firm is mid-tier, regional, the kind of place where the senior partners wear the same suits they bought in 1987, and the conference room still has a projector that requires a bulb replacement nobody has ordered. You do tax returns for orthodontists and small manufacturers. You reconcile accounts for a chain of dry cleaners whose owner keeps 3 sets of records and is not particularly subtle about it. You say nothing. You learn something. The gap between what numbers say and what numbers mean is wider than they taught you in any classroom. You're good. Better than good. You're the kind of accountant who reads a balance sheet the way a surgeon reads film, not looking for what's there, but for what shouldn't be. Anomalies. Asymmetries. The places where the architecture of a financial statement is holding something it wasn't designed to hold. You find errors nobody asked you to find. You correct them anyway. You bill your hours and you go home. At 29, you have $94,000 in debt and a salary that looks reasonable until you calculate it hourly. You do calculate it hourly. That's the kind of person you are now, the kind who cannot stop running numbers even when the numbers are about yourself. The call comes on a Tuesday in November, not an email, a call. A man with an accent you can't immediately place, somewhere between Geneva and nowhere in particular, explains that a consulting arrangement has become available. The firm is a name you recognize, not from news, from the kind of directories that don't publish online. They represent family offices, multinational holding structures, cross-border investment vehicles. The retainer number he mentions is roughly 4 times your current annual salary. You tell him you'll think about it. You don't sleep. You accept within 48 hours. The office is a floor of a building in a city where buildings are measured in discretion rather than height. There's no signage at reception. Your badge says the name of a subsidiary you've never heard of, a 2-word combination, clean and forgettable, like a password chosen to be forgotten. Your title is Senior Compliance Advisor. You will later understand this is the financial equivalent of a magician's scarf, something to look at while the actual work happens elsewhere. The first 3 months are almost legitimate. Transfer pricing documentation, tax-efficient holding structures for European family wealth. You reorganize the ownership cascade of a Mediterranean shipping concern through a Malta subsidiary into a Netherlands cooperative. Standard work, textbook even. You are very good at it. They notice. The work becomes more specific. The first shell company you build is called Ardent Maritime Solutions Limited. It is incorporated in the British Virgin Islands on a Thursday and owns nothing, has no employees, no physical address beyond a registered agent's office where 300 other such entities also technically live. Its sole purpose is to receive a payment of $4.3 million from a management consultancy in Dubai, which is itself owned by a foundation in Liechtenstein, which traces back, if you follow the structure far enough, to a name you will not write down. Ardent Maritime Solutions receives the payment. 2 weeks later, after passing through an intermediary loan structure that converts the income into what looks like intercompany debt repayment, the entity is dissolved. The money is clean. The company never existed in any meaningful sense. You've created and killed something with a few keystrokes and a registered agent's fee of $1,200. You build 7 more like it in the next 4 months. You stop naming them. Your supervisor, a Belgian man of indeterminate age who wears no watch and carries no phone, calls this process cycling. You cycle structures, he explains, the way a farmer rotates crops. The soil needs to rest. The structure needs to disappear before anyone develops an interest in what grew there. You start to understand the economics of the invisible. Incorporation fees, registered agent retainers, nominee director arrangements, apostille certifications. The overhead of a shell company is lower than the annual maintenance fee on a brokerage account. The real cost is elsewhere. You learn this when you're handed a file and asked to reconcile an unusual expense line. The description reads, Assurance Services, Third-Party Review. The amount is $340,000, paid quarterly to an individual whose name you cross-reference against a public database out of reflex. He is a senior partner at one of the largest audit firms in the world. You close the file. You open it again. You look at the payment schedule. Quarterly for 6 years. You look at the audit sign-offs for the entities this man's firm has reviewed. Clean opinions, all of them. Unqualified, untroubled, unremarkable. You understand now what the line item is. Not assurance services, not third-party review. You are looking at the cost of invisibility itself, billed quarterly, accepted without flinching, built into the operating expenses of a machine that has been running longer than you have been alive. You tell yourself this is different from what you know it is. You reconcile the line item. You file it correctly under the appropriate expense category. You go back to your hotel. You are always in hotels now. Different cities, different rooms, the same silence. And you order room service and watch financial news on a channel that is reporting on corporate governance reform in Southeast Asia with the same tone your dry cleaning client once used to explain why his third set of books was just a personal preference. At the end of your first year, your retainer has been adjusted upward, significantly. There is a bonus structure attached, the terms of which are explained verbally and never documented. The Belgian man tells you that you have an exceptional instinct for structural elegance. He says this the way someone might compliment a surgeon's hands, clinically, without warmth, as an assessment of utility. You thank him. You don't ask what happens to the people on the other side of the structures you've built. You know enough about accounting to know that money moved invisibly doesn't disappear. It arrives somewhere. You don't model the destination. Nobody asks you to. That is the first rule of shadow work. You are not paid to follow the money. You are paid to make sure no one else can.
By year 3, you have stopped thinking of yourself as an accountant. Accountants record what exists. You architect what cannot be found. There is a professional distinction there that your licensing board would find disqualifying. You have stopped thinking about your licensing board. The work has a rhythm now. A new jurisdiction opens. A bilateral tax treaty shifts. A beneficial ownership registry tightens in one country and loosens in another. And you respond to the regulatory landscape the way a river responds to terrain. You don't fight the geography. You find the new path. Cyprus tightens, you move to Mauritius. Mauritius tightens, you move to the Seychelles, then to Singapore, then to structures so layered that the question of jurisdiction becomes genuinely philosophical. Where is this company? Everywhere and nowhere. Who owns it? The answer requires 11 documents across 4 languages, and by the time anyone assembles them in the right order, the entity no longer exists. You manage what your supervisor now calls the parallel ledger. Every legitimate business operation has 2 sets of records. This is not, he is careful to explain, 2 sets of books in the crude sense. It is 1 set of books for the world that needs to see them, and 1 architecture of related entities, flows, and instruments that gives those books their shape from the outside. The legitimate ledger is the shadow. The shadow ledger is the substance. You are the only person with access to both simultaneously. That is your value. That is also, though you won't understand this for some time, your problem. You meet the client once, only once, a room in a private terminal at an airport in a city you won't name. He's older than you expected, quieter. He doesn't ask about structures or entities or tax efficiency. He asks a single question, are the foundations solid? You say yes. He nods once and the meeting is over. You understand from the Belgian afterward that this man's organization moves capital across 14 countries in a manner that, if charted accurately, would resemble a circulatory system, constant, pressurized, invisible from the outside, catastrophic if interrupted. You are one of the valves. You are 41 years old. Your personal accounts hold more than you will spend in several lifetimes, distributed across instruments that your former self wouldn't have known how to name. You have no mortgage, no car payment, no credit card debt. The $94,000 that once defined the ceiling of your anxiety is a rounding error now. You do not feel free. You feel like a man standing in the center of a structure he built himself and cannot find the exit of. The first sign comes through the work. A set of reconciliation files forwarded to you by the Belgian contain a subsidiary you don't recognize. Not unusual in itself, the architecture is vast, but this one has your name on the directorship, not as a nominee, as the actual recorded director. You've never signed a document creating this. You call the Belgian. He is unavailable. He is unavailable for 11 days, which has never happened before. You pull the incorporation records yourself. The entity was formed 9 months ago. It holds a single asset, a residential property in a jurisdiction with no extradition treaty to the country currently running a financial crimes investigation that you read about in 3 paragraphs of a regional business publication 6 weeks ago. You read those 3 paragraphs again, from memory, standing in a hotel bathroom at 2 a.m., and you understand with complete clarity that the asset in your name is not for your benefit. It is a location. It is a body. This is what the exit package means. Not retirement, not a graceful transition to advisory emeritus status. The exit package is the moment when you become more useful as an explanation than as an employee. Your name on a directorship in the right jurisdiction, your signature on documents you may or may not have signed, your professional credentials lending legitimacy to a structure that will, when the moment requires it, point directly at you and nowhere else. The machine doesn't eliminate the people who know too much, it repositions them. It moves them from the inside of the architecture to the visible face of it, just in time for the face to need to be seen. You spend 4 hours doing what you do best. You run the structure backward. You find every entity where your name has been placed without your explicit knowledge. There are more than you expected. Not hundreds. Enough. Enough to constitute a financial biography of someone who built exactly the thing investigators would be looking for. A career-long pattern, a paper trail of one man's knowing participation in the movement of money across the better part of a decade. The documents are not forged. That's the sophistication of it. Your signatures are real. Your registrations are real. You attended the meetings. You signed the opinions. You filed the reconciliations. The architecture is accurate. Only the authorship is wrong. You were the instrument. The instrument can be held accountable. The instrument can be displayed. You close the laptop. You sit with it for a long time. Then, you do the only thing that your training, all those years of finding what's buried in the numbers, actually prepared you to do. You build a structure of your own. Not entities this time. Documentation. A parallel record of everything you've processed, cross-referenced against the payments you've received, the verbal instructions you've cataloged in files no one else knew you kept, the timestamps that don't align with the directorship formation dates, the beneficial ownership threads that lead away from you and toward the man in the private terminal who asked only if the foundations were solid. They are, but they don't point the direction he intended. You have one asset he doesn't know about. Not money, not property, something more durable than either. You know where everything is. Every structure, every flow, every quarterly payment to every senior partner whose clean opinion made the invisible possible. You know the name of the reinsurance vehicle. You know the currency block. You know what the sovereign wealth fund in the Gulf is actually anchored to. You are 41 years old. You have a credential that cost you 4 attempts and 3 years of your life. You have a laptop encrypted with a key only you know, and a document that, if assembled correctly, describes an architecture that 17 regulatory bodies across 9 jurisdictions have been trying to reconstruct for the better part of a decade. You do not make a call yet. You make a copy, then another. You distribute them the way you once distributed risk, across multiple locations, multiple formats, multiple fail-safes, no single point of failure. You think like what you are, the most dangerous kind of person in finance, not the one who moves the money, the one who knows exactly where it went. Somewhere in a glass tower in a city that never stops moving, a 23-year-old woman opens a textbook on intermediate financial accounting. She is studying for the second section of her exam. She believes, with the specific confidence of someone who hasn't learned otherwise, that the system rewards what you understand. She's right. She just doesn't know yet what the system actually wants you to understand, or what it costs to understand it completely. The terminal blinks. The numbers don't lie. The people who arrange them do. The machine takes another step forward.